Good evening. I'm Steve Van Metre. Welcome to our Wednesday Night Live. If you're wondering where I was Monday, and I was here, not live because there was really nothing to add since Friday. You know, the markets were pretty muted on Monday, and I think they were looking for the State of the Union address for perhaps some direction from President Trump, and well, they really didn't get it. So what I'd like to do tonight is kind of recap, how we got where we're at and address the question that everyone's kind of asking right now. Are stocks headed higher, or are they coming back down to retest their December lows? So we have to go back to December to figure out, well, how did we get where we're at? Well, the first thing that happened is Treasury Secretary Steven Van Metre called what is affectionately referred to as the plunge protection team to prop up the stock market. Now, there's a lot of misinformation about the plunge protection team and what this does. There is a government group of people that do talk about the markets, but there's no government authority, not one, the Fed, not Congress, nobody has the authority to buy stocks. Yet, if you ask people, they say, oh no, they do, it's just hidden. They don't. There's no legal authority. Now, if the Fed is buying stocks and it's ever found out, I can guarantee you that Congress is going to strip the Fed of all their powers faster than you can blink. And if you don't think Congress wants to do it, oh, they're dying to in a big, big way. So no, the Fed isn't doing that. But what followed that was the notion that the Fed was going to ease. And this was all a rage of, oh, the Fed's easing now. And boy, you got to get in the market because it's going just to the moon now. The Fed is back in play. They're going to stop the balance sheet unwind. They're going to do QE4. They're going to lower interest rates to zero. And none of that actually happened. The Fed has not budged the federal funds rate. They didn't do anything at last meeting, and we've looked at this. They have also continued to unwind their balance sheet, including today. Now, back when Janet Yellen was Fed chair, you would see, the balance sheet going along, and then you could see when she was juicing it, and then she'd let it go and juice it and let it go. Nothing. In fact, this week, the Fed has defended its balance sheet unwind, saying that they don't see any problem that it's causing anywhere in the markets or anything, and that they're still going with it. Well, the next thing that got people all hopped up about the market was the end of the trade war. That was coming. It's been coming for a year now. Nope, because trade war with China is not about trade. If it was simply about trade, this would be done a long time ago. It's not. We're not anywhere closer than we were a year ago. So that's not over. Then all the excitement was, well, the government shutdown went, and that's got to be bullish for stocks. I don't see how government shutdown is bullish for stocks either one way or the other. But the fact of the matter is, when LaGuardia gets shut down because there aren't enough air traffic controllers to direct planes, they're going to get some phone calls about that. Hey, some politicians, people are going to make some phone calls. Some very wealthy people are saying, look, I can't conduct business because what you fools are doing. And yes, that is going to cause attitudes to change. Of course, we're facing a potential government shutdown in 9 days. So, who knows? So the reality is, all this excitement of you've got to pile into stocks because, as an article I saw yesterday or the day before said, if you've missed the train, you are too late. We're going higher and higher and higher. But the reality is, the Fed has not changed their position. The trade war is not over. The balance sheet is still going down. The money supply is still falling. And that's very bullish. Bearish for stocks. Kimberly, thanks for joining us. Ray, glad to see you here, buddy. Let's, before we look at some charts, because that's why we're here, is to see what's going on. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as recognition or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in this video that I do not affect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Advisory service offered by Atlas Financial Advisors Inc., a registered investment advisory firm. All right, so let me clear that out of the way. So again, our goal tonight is kind of figure out stock market go up or down and why people think it's got to go higher. Well, the simple reason is markets always want to go higher. There's little doubt. Everybody wants the market to go up indefinitely. It doesn't. It's cyclical like anything else in this entire universe. Find me something that's not cyclical, and then maybe I'll agree that the stock market isn't. But you have to go back in time to 2007 to see why people have this attitude. So let's first look at the charts currently, and then we'll go back in time and take a look. All right, so here we are. Now my regular viewers will know I thought 2,600 was the point of no return. I thought it was going to stop there. It got to the 50-day moving average. I thought, well, then that's for sure where it is. Nope. It got to the 100-day. I said, well, that's got to be it. Nope. It got to 2,700 right at its 200-day moving average. And it's been sitting there for pretty much 2 days now. And you can see, looking at these very heavy support, or what was support, that briefly became resistance. And now it's up here and could it go a little higher? Sure, it could get to 2,800. I'll just say it's not. So everyone that wants it to go higher will have satisfaction knowing it could. But let's go back and look at 2007. And I've got to zoom this in or else it won't look right. And I'm glad it's working, because a few minutes ago when I did this, it didn't work. So let's see. There we go. So here's what everyone wants. Here's back in 2007. Market went up and has come down. So you could say that we're probably here in the mind of most investment professionals right now. They expect a higher point for the market to go. They expect one final last hoorah to push the market higher. This is what they're looking for. Now in 2007, really didn't go that much higher, but this is what people want. And the argument for this right now is, well, corporations are buying their shares back. Well, let's look at the facts on that too. So in 2007, or 2018, gosh, I'm now looking at 2007, I'm off by 11 years. So 2018, you had the world's largest record corporate share buyback program in the history of the United States and the world executed. On top of that, you had a massive stimulative tax cut. And what happened? The stock market was negative. So it was negative for 2018. All because the Fed was raising interest rates and tightening their balance sheet. It is just purely the power of the Fed here. I mean, that's how strong they are. So this year, corporate share buybacks are going to be lower, and the Fed is going to tighten at least at the same rate. Even if they don't hike the federal funds rate, their balance sheet unwind is going to have the same net effect, and we have no tax cut. So the notion, just from that standpoint, that we get a higher stock market doesn't make a whole lot of sense. But anyways, this is what people are looking for. Now, what you can see here is this low back in 2007 was retested. Looks like, 3 months later, the low was retested. So let's go and now fast forward to current times. And look what happened. Well, let's zoom out 2 years so we get a little more space. So here we have the December lows. Plunge protection team, Fed easing, end of trade war. Yeah, none of that happened. So what's the next destination? Now, could this go up in here to, could the S&P get up into the 3,000s? It can. It's highly unlikely because, again, the big difference between 2007 and you can even go back to 1999 and any prior recession, never in history has the Fed unwound their balance sheet. Never, ever once. So this is a big deal. So we have a new cog in the machine that no one's seen before. All we know is quantitative easing created a wealth effect. Quantitative tightening should do the exact opposite. But now all of a sudden, no one thinks that, except like me and 5 other people. So the next move for the market is, whether it's higher in this very short term, is a retest of this 2018 lows. Now you say, well, Steve, okay, you've been predicting bad things for a while and they haven't happened. Okay, well, when they do, we'll see. But let's go back to 2014. So here we have a low. The market shot up and kept going. This is what everyone wants right now, boom and rise. But look what would happen in 2015 and then later in 2016. Not only did it come back and check this low once, it checked it twice, 3 times, 4 times before it kept going. But this time, I don't think we're going to see that I don't think it's going to hit this low and bounce. I think it's going to hit this low and then go down to somewhere down here. I think it's going to be somewhere between around 1,800 to 2,100. I think this is the next destination. And I've shown this in charts based on the Fed's on the monetary base. And the monetary base is made up of all the currency in circulation, so the money you and I have in our wallets and our bank accounts, plus excess reserves. Now, what's really interesting is the Fed's unwinding about $50 billion per month, plus or minus a little bit, because it doesn't always exactly equal that. $30 billion of that is going straight to the excess, killing excess reserves. Meanwhile, $20 billion is being offset by the growth rate of the money supply, which is still positive, but it's really, really low historically. So the balance sheet unwind is continuing. It's going to put downward pressure on stocks. And what's going to happen? All of a sudden, one day, liquidity or money in the market is just going to go poof. And stocks are going to go whoop. And then you go, because risk happens fast. Now, there's some other ways we can look at this market and tell you that, hey, things aren't what you think. And one of those is the bond market. So let's look up and overlay 10-year Treasury yields. And if you don't understand the relationship between bonds and the stock market, it's okay. I'm going to write about them for Friday, so you'll see them this Friday. And I'll mouse over so it's dark purple, but you can see here the Treasury yields rise with the stock market and fall. Now, right now, you see Treasury yields are headed lower, so people who own bonds are wanting to see that. They want to see their bond prices go up. And the market is going clearly up here. So what is everybody hoping for? They're hoping for a repeat of right here, where the yields went up, came back down, hit a support level, and then shot straight up to validate the move in the market. But so far, we're not seeing anything convincing. This little bounce got rejected like 2 days later. So it was down yesterday, down today, and at least briefly in overnight trading is still headed down. And we know it's going lower, mainly because the banks are buying bonds at a record pace. I mean, they've been buying a ton of them, and we know that monetary decelerations lead to lower long-term yields, not higher, when you are reserve currency like we are, and you have rules in your central bank where you cannot print money. So we know that for a fact. The other non-confirmation is oil. And oil is not generally tied to the market, but lately it has been. And I'm going to see, I have not pulled this up yet, so we'll see what it looks like. I'm going to pull up the oil producers. And I like the oil producers because I think they're a little bit better process. I mean, they are stocks to begin with, which is nice, but they track oil. So anyone who's invested in oil, the companies know that when oil prices go up, generally the stocks go up. When oil prices go down, the stocks go down. So they're a really good proxy for the oil market. And let's take a look. And you see again, the oil producers, they were validating this rally on the way up, not validating it here. In fact, we can zoom out. Now, with Treasury yields, you can't zoom out too far because their correlation is pretty tight. But you can see oil producer stocks followed right up, right down, and are not confirming this move here. So all this is telling us between the oil producers and Treasury yields is the broad stock market should be somewhere between 2,500 and 2,400. That's where it ought to be right now. So unless we see a big move higher in Treasury yields and oil, and notably, which is interesting because on my daily updates, I post the API, American Petroleum Institute, and the government data on Wednesday. So API reports Tuesday, which is highly inaccurate, but it's still fun to look at. And then the official government data on Wednesday. And I have been predicting, and my contacts have been telling me all over the world, there is a glut of oil, even though it's not being reported. That above ground storage is full, below ground storage is full, tanker storage is full, and yet everyone's speculating that oil is going higher because, again, after 10 years of an economic run, everyone's got it locked in up here that this thing just is never going to end. And then on Wednesday, today, I'm thinking it's Monday because I didn't do a Monday update. So this morning when the EIA reported, and there was a build, now, of course, analysts have been predicting, now they're predicting a build, but it wasn't as big of a build. And there were immediately articles following saying, oil investors are now worried there may be a glut. Well, they should have been worried about a glut about a year ago because that's when it was starting to build. So if this oil build continues, well, you can tell you what direction the market's headed alone. So that's our update tonight. I'm just going to check and see if there's any questions. I want to thank everyone who joined us tonight. Kim and Ray, appreciate it. And for all of you who are watching on a replay, I hope you enjoyed it. If you have questions, let me know. And we'll be back on Friday for a more longer, comprehensive weekly economic update. And I hope to see you then. It's Wednesday night. I'm Steve Van Metre. Bye now.